Hey everyone! Over the course of the last month, I've done a couple videos where I focused in on commercial real estate distress and foreclosures. And a lot of people have been really surprised that the distress levels aren't far worse than we've seen so far. Institutions have created enormous opportunity funds focused on targeting distressed assets. Billions of dollars of dry powder waiting for what many believe to be an inevitable outcome from the rapid rise of interest rates. And several investors have reached out to me asking why there isn't more distress or whether that shoe simply hasn't dropped yet. While more distress and more foreclosures could still come, I was recently looking at a graph that reminded me how narrow the band of higher risk assets really is. The graph is an index of property prices based on MSCI data, formerly RCA, benchmarking values compared to the fourth quarter of 2019, pre-pandemic prices. And for several property types, there's a bell curve that peaked in 2021 or 2022. Generally speaking, as of the fourth quarter of 2023, most property types still have net positive average pricing relative to the fourth quarter of 2019. Now remember, we're playing with average numbers here, and depending on the asset and the market, some properties are doing better and some are doing worse. So this is really looking at an overall average. So in aggregate, only office properties are valued below where they were at the end of 2019 before the pandemic. And that's part of why office properties will likely face the greatest levels of distress and foreclosures in this cycle. Another interesting property type is retail. Retail is the only property type with upward pricing momentum at the end of 2023. So, compared to the end of 2019, retail values are about 8% higher than they were, but the values undulated over the course of the last 4 years. Since mid-2023, retail property prices have been rising again. So I expect retail property distress to be limited because even if an investor bought at the height of the market, values are still within a relatively limited range and they're trending upward based on their particularly strong fundamentals. Then there's apartments. Again, if a property was acquired in 2019 or even 2020, then the current value is on average still net positive. Like retail, multifamily prices peaked in mid-2022, about 33% above the pre-pandemic pricing. But since then, prices have fallen about 14%. So they're just 15% above pre-pandemic levels. Now, in looking at this, I think multifamily investors may be facing some unique situations. In general, I don't think the values have fallen enough to create a wave of distress, but there are probably some investors who bought at the peak of the market who are undercapitalized and underwrote the assets with overly optimistic assumptions who are now facing some real challenges. Those properties might come out in distress, but there may be opportunities for well-capitalized investors to acquire these properties in some sort of a bailout model. The multifamily sector faces a bit of a choppy outlook in 2024 due to the significant volume of new development coming online. That will push up vacancy rates and weigh on rent growth. As a result, the market may be just challenging enough to push some apartment investors to seek rescue capital or another means of getting out from under these properties. When I look at the pricing index for hotels and industrial properties, the bell curve doesn't really show up. Both of those property types have held values roughly on par with their peak. Industrial distress is negligible, and hospitality property distress is really property-driven rather than market-driven. Then there's self-storage. Self-storage actually got a lift from the pandemic, so storage values didn't peak until the third quarter of 2023, and since then, values have come down by a few percent. This softening is being driven by increased competition and slower household formation, which has weighed on storage demand and resulted in rising vacancy rates. That has triggered increased competition for tenants and in turn suppressed rent growth. At this point, I don't see broad-based distress coming to the self-storage market, at least not over the short term. Essentially, the pricing trends reiterate my suggestion that distress will be limited for most property types this cycle. There will, of course, be some, there always is, but it's unlikely to reach the magnitude some of the opportunity funds were hoping for. Given a soft landing outlook and the prospect of modestly lower interest rates, investors may want to rebuild their strategic thesis and focus on upside opportunities that could emerge over the next 5 years. As always, investors need to keep their eyes on the horizon.